Now, the final part of this reading present a very interesting and very useful tax management tool. It's called the tax loss harvesting. This has been commonly used in Wall Street for generating additional returns. How does that work? All right, let's look at this example here. Suppose you have a taxable portfolio with $1 million, and this year's the recognized gain from the investment is $100,000, and the capital gain tax rate currently is 20%. Here, now you look at your portfolio and you see there's some security had some loss, even though our total return is positive. But if some element in our portfolio, those security experience some loss. Say these security we calculate that it's going to have around $60,000 loss, capital loss. So, and we're thinking about those security. This year they have a loss, but they have a potential to get those loss back next year because those are a pretty good company. Something happened in specialized in one in the industry that was impacted by some external factor, but this it's a unique factor, but it's going to recover later. For example, something happened in the aviation industry or something happened in the pharmaceutical industry, but it's a normal event, and the next year they will come back. So, you need to consider that maybe we should sell those security now, and then immediately buy back some of the related security in the same industry, so we can realize the loss first. Suppose you do that, you can put the unrealized loss, convert that to the realized loss. So that way you're able to save your tax. So there's a tax saving here. All right. So how much you're going to save if you sell the security with a $60,000 loss? So you're going to put your gain from 100,000 down to 40,000 with 20% tax rate. Then your tax saving here is around $12,000 because originally you got to pay 20,000. Now you only have to pay 8,000. So you save $12,000. So that's your tax saving. Now, for the tax saving, if you look at that for the long-term purpose, actually is more like a tax defer. Now, let's use a 2-year, for example, just for 2 years. Now, think about this. This year, we're going to generate a loss for $60,000 by selling those stocks. All right. And suppose the $60,000 loss is from a regional cost of those security of $170,000, and the current value in year one is it's only of $110,000. So that's the reason we have $60,000 loss. Now, if we compare this without and with selling those security, what happened to our tax liability? Well, let's assume that the next year, the second year, the security value does increase to $200,000. All right, and you have to sell that security regardless what in the next year. So we like to see the tax exposure or tax liability. Now, option A is you don't sell, you don't harvest the loss, so you don't sell those security, you hold it. Option B means you do tax harvesting and you sell that one year one and buy back in the year one and then sell that again in year two. So what happened? Now, year one, you're paying 20% of the total gain of $10,000, so your tax is $20,000. And the second year, With this security, for this we just focus on this security. Uh, Original cost 170, and now the value from 110 now increased to 200. So there's additional capital gain value, and you're gonna pay tax 20%. So you're gonna pay $6,000. So in total, you have to pay 26,000 bucks. Well, the option B, you're gonna sell that. All right, in the first year, you realize the loss. So your real return, the realized return is only $40,000. So you pay in $8,000 tax. But the second year, since you already invest, you use the tax, you sell that one and you buy back at the same time, and your value will increase from 110 to 200. Then the second year, your tax exposure is going to be $18,000. So if you put that together in first 2 years, the sum of those 2 years, your tax rate, your tax liabilities is identical. They are identical, $26,000. So you say, wow, it's the same. I mean, if you do the tax harvesting and the tax saving you have now this year simply just postponed to the next year. The value of tax loss harvesting is largely in deferring the payment of tax liability. And you may ask the question, so what is the point that we actually defer? All right, or we actually want to defer the tax liability, and by realizing the loss in the first year for so-called tax harvesting. The question, the point is this, is that this $12,000, this $12,000 saving you have there, you're going to reinvest. It's not just holding that. You're using that to buy the security, and using additional numbers, the tax saving, you buy additional share. That give you more return. All right, let me repeat. If you only look at the tax liability, really there's no much difference than holding or selling for 2 years, across 2 years. However, the difference is that the tax saving in the first year, the $12,000, you're able to buy more share that will give you more return. That is the true effect from the tax harvesting. All right. Now let's take a look at this. All right, I'm going to show you here. So if you see that here, say there's a terminology called adding net of a tax principal, which means additional saving from the tax harvesting. So realizing a loss save tax in the current year increase amount the net of tax money available for investment. The $12,000 you can invest. All right. Now I'm going to evaluate based on two scenarios. Option A, you hold the security. Option B, you sell the security and reinvest the proceeds and the tax saving both in the nearly identical security. Okay, so this is called the strategy of tax harvesting. So, by the second year, the security increased by 81.81% because the value increased from 110,000 to 200,000. That's a huge increase in terms of percentage, or in terms of the value. Now, realize that the tax saving in the year one, right? So you sell that security, you're going to gain $12,000 additional cash. So you're putting the $12,000 plus the proceeds you sell of the 110,000. So you are actually increasing the $22,000 $122,000 in total, not just only the 110. So the $122,000 is going to grow by 81.81%, will give you $221,808. Now you look at that, the return from that, $221,808 from the $122,000 investment. That is a huge return, and you, of course, you got to pay tax. Capital gain, you're going to pay the capital gain of $19,962. But anyhow, even though this tax you pay, but your after-tax outcome actually better off. Now we can put in this table here. If you don't do that, option A, $200,000, you're going to pay additional $6,000, right? Of course, because the value for the security increase. So for this security purpose, the after-tax value is $194,000, right? From 110 gross to $200,000. Now, for option B, because you invest more in the security, so your base is higher, you increase to $221,808. Even though you are paying a higher tax on that, your after tax will reach to $201,846. If you calculate that, the additional return you have from the tax the tax harvesting, all right, the $201,848 compared to $194,000, you have additional 11.35% return. This is a lot of return, 11.35% return. Just simply sell that one, sell the security in year one, and reinvest in the year one, and putting additional tax saving, all right, into the security, you're going to generate more return. In this case, by 11.35%. That's quite significant.